Hello, everyone. Welcome to the Siegel, Bryant & Hamel Investment Summit. I'm Carolyn Goldhaber, president of SBH, and today I'm joined by Jeff Paulis, senior portfolio manager for our small cap strategies. Welcome, Jeff, and thanks for joining us today.
Glad to be here.
Thanks. Well, it's been well documented, especially recently, that the quality profile of the Russell 2000 index has notably declined over the past 2 decades, with lower quality companies now making up a greater portion of the index. In your view, what are the key drivers behind the degradation?
Yeah, so we just authored and published a study on the changes in the quality factors within the Russell 2000 over the last 20 years. So if you'd like to see that and have not, please reach out to your SBH contact or go to the Siegel Bryant Hamel website. And the punchline is that the top half of the Russell 2000 has remained largely consistent from a quality perspective over the last 20 years, but the bottom half, and specifically the fundamentals of the fourth quartile or lowest market cap companies, have really degraded over the last 20 years, according to the data. And we were looking at things like return on invested capital, free cash flow margin, and the number of profitable companies. And so please kind of take a look at that report to see that data. But the key drivers of the degradation that we've seen in that index over time has been really kind of 5 factors that we would point to. The first would be the migration of higher return on capital companies or improving return on capital companies to higher market caps. Those companies have appreciated, they've moved out of the index. And so you're left, naturally with just more lower ROIC businesses. The second would be higher quality companies have remained in private ownership, i.e. companies haven't wanted to become public or publicly traded stocks for whatever reason. Third, higher quality private and public companies have been bought by private equity and strategic buyers, which have kept them out of the public markets. Some of those bigger companies, as well as low interest rates, have attracted companies to kind of buy these higher quality companies, looking for growth in the post Great Financial Crisis period where the economic recovery underwhelmed. So they looked for these higher quality private and public companies to buy to add to their portfolios to drive growth. Low interest rates also drove less mature companies to enter the public markets earlier. And you've also had an increase, particularly in the 2021 timeframe, an increase in the number of SPACs or special purpose acquisition companies, which was a quick way to bring companies into the public markets. And a lot of those ended up being lower quality companies, and a lot of them are in the Russell 2000 today.
Sure. So what are the implications of this shift for active small and SMID cap managers?
Yeah, the real implication is there's not a better time, we believe, to be in active management in the small and SMID cap space because of how the index is composed now with being lower quality, particularly at the lower end of the market cap range. So higher ROIC companies typically outperform lower ROIC companies over time anyways. So if you have an index that is now more low quality than ever, it's reasonable to believe active managers could potentially have a higher probability of outperforming the index, more so now than it ever has. And there's some great companies in the small and SMID space. There always have been, always will be. In the top half of the Russell 2000, as we show in the paper, these are good companies, and they have been over that duration of our study. They have stable ROIC. Stable, free cash flow, maybe even improving free cash flow margins, and are largely profitable. And our job is to find those and invest in those and watch them create value in our portfolios. Our job also is to identify these lackluster businesses, these lower ROIC companies, and stay away from them. We've seen in the lower market cap area of the Russell 2000 a real degradation in the fundamental quality of those businesses, as we discussed. And we generally have and will stay away from those, which we believe has contributed to our outperformance over past market cycles. And in the interest of time, another implication, I won't get too much into the cost of capital environment we're in now, which is way different than we've been in for the last 15 years. But should rates remain high, that only further supports our case. And myself or members of our team are happy to jump on the phone and talk to this in a little bit more detail. But again, I'd refer you to the document that we published. It's short, it's to the point, about 2 pages long, with some charts that help show what's been happening over time and kind of really gets at the nature of this question.
Great. So let's jump ahead into, while your portfolios remain oriented towards high ROIC companies, you've mentioned being ready to accelerate your shift towards improving ROIC opportunities as the earnings weaken. What factors would cause this rotation in your portfolio?
So we've been weighted more towards higher ROIC companies for a number of reasons. Generally the philosophical fit is better with what we believe in, but we've also had this kind of slowing economic backdrop amid the rising rate environment and rising cost of capital, which puts disproportionate pressure on lower ROIC and levered companies. Just to name a few factors. Also, the list of risks in the economy and for our companies has just continued to grow over the last couple of years, which caused us to make this shift towards higher return on invested capital companies. A lot of those risks that we identified are now playing out in real time. We've been expecting earnings to weaken throughout 2023, and that's really started to happen. Every quarter through 2023, we think the environment and therefore the revenue and earnings of small cap companies, generally speaking, has gotten a little bit weaker. And so you've seen the Russell 2000 and the Russell 2500 earnings expectations have been continually revised lower through for 2023 and 2024 as we move throughout this year. And so as those earnings have weakened, we've seen the market and individual stocks move lower in reaction to that. And as those stocks move lower, what we call the upside downside ratio or the reward to risk ratio has become more attractive, particularly as we look out over our evaluation period of, call it 18 months plus or minus. So that risk reward improvement would be one factor that we're looking at. The stocks have come in, they've become cheaper, taking a longer term kind of time frame in our analysis. The risk reward is starting to be there as the market pulls back, as earnings have come in. And so if a stock meets our philosophical criteria, ROIC, niche market competitive advantage, strong management team, and attractive reward to risk ratios, we'll initiate a position. What will really help a lot from an improving ROIC company perspective is the Fed also backing off its interest rate raising campaign. That would cause the economy to start to strengthen again instead of weaken, which is what we've seen now for several quarters. And that would really create a more favorable backdrop for a lot of these companies, which would also cause us to accelerate our shift to those improving ROIC businesses.
Great. And that's really a perfect segue, Jeff, to wrap up our conversation today. What is your outlook for the market heading into 2024, and what factors will you be closely watching?
Yeah, so we think 2024 is going to be a tale of two halves. The first half, we think, will be a continuation of what we've seen in the second half of 2023. So somewhat of a difficult environment. And then you likely begin, we think, the rebound process in the second half of the year because the Fed is cutting rates in response to more weakness than they expected in the economy. We think the first half is going to be difficult for several reasons, many of which we're seeing now. Earnings will continue to decline in the small cap area. Earnings have been being cut for small caps since kind of late spring, early summer of 2022. That continues all the way through today, and we don't see that stopping for another few quarters. The lag effect of the Fed tightening remains in the pipeline. So there's some tightening that the Fed has done. There's typically a lag between when they take an action and when you see that result in effect in the economy and in our company's fundamentals. That is still tightening. So we think things don't get worse from that. Also, international demand, just Europe and China generally, bigger picture, remain pretty soft. The geopolitical events and the impact that can have on confidence, which we saw with Russia, Ukraine, and now what's going on in Israel, we think that dampens both consumer and business confidence. The U.S. political dysfunction in the 2024 election cycle, some of the companies we've been talking to are already calling out the election cycle and the potential uncertainty that could create as maybe a risk factor. And then we've had rising energy prices, dwindling savings, student loan payments starting back up in the October timeframe, which has put a bit more of a weight on the consumer. And then, just the unknown of a surprise every tightening cycle. Something happens where, there's a large negative surprise. Maybe we saw it in March with what happened in the bank crisis. We don't know. But history tells us that there's something breaks in every Fed tightening cycle. So will something occur again in 2024? We don't know. But there could be, just based on history. So we think all these are going to work to be headwinds for the market throughout 2020, the first half of 24. This likely results in the labor market weakening, and we think that this is likely to get the Fed to begin cutting rates at some point in 24. You don't know if that's early or late, but we think as the Fed either changes its tune or begins to cutting rates in 24, that's going to drive some optimism on an economic recovery that an economic recovery can begin. and therefore the market should begin to stabilize and to move higher off its lows, once there's a kind of a visible sign for that to happen.
Right. I mean, who knows what the future holds, for sure. And a lot of different factors will contribute to that. But Jeff, as always, I appreciate you taking the time today to share your perspectives on the small cap markets. If anyone has any questions on anything that Jeff discussed or finding the charts Jeff mentioned, please don't hesitate to reach out to your SBH sales rep. You can find their contact information on our website at sbhic.com.